I'm happy to give the last talk, the last academic talk. I've enjoyed listening to the research that we've had presented this morning and this afternoon. The title of the presentation is Sunk Costs, Regulatory Uncertainty, and Firm Investment, which is a little bit of a mouthful. However, taking the first letter of each word, we have the SCRUFI project. It is joint work together with Mark Burton. Where are you, Mark? Right over here, Mark, you moved. And my colleague, John Mayo from Georgetown University. All right, so I was a little bit worried before we started this quickfire round that really we would have underexposure to one of the most remarkable figures that I've seen as a microeconomist. I'm going to show you my version of it if I can get the clicker. Here it is. This is something you've seen from Professor Macker as well. It's a summary of the freight railroad performance over the late 70s, 80s. I guess I've got the 90s here too. I drew the staggers as the black line in 1980. And what comes out of this figure is that after staggers, prices and revenue in the industry went down, quantity went up, and productivity went up as well. Now, there's a lot of different measures of productivity. Here, I'm just taking ton miles and dividing by operating costs, okay? Now, in the railroad industry, you kind of get a little bit numb to this figure, I think, because most academic articles on railroads show this figure at some point. I've seen this in this conference in previous years, but as somebody who doesn't actually, I haven't done previous research in rail, I find this very striking. And so I want to ask the biggest question, interpreting this as a case study in economic growth. What is it that might explain this growth, okay? And of course, in some sense, we know it's about staggers and the Staggers Act. But attributing the economic growth to deregulation, either it's not complete or it's not precise, or maybe it's not specific enough, because we know that some industries, but not all industries that go through deregulation experience this sort of phenomenon. Now, the data suggests something on the cost side. And the reason I say that is we observe that prices are down and quantity is up. All right, what generates that in data? Supply shift out, a reduction in marginal cost. Or equivalently, we can just look at the productivity number. The railroads are more productive than they used to be. All right, so our first take, probably this is a cost phenomenon. However, the qualitative evidence seems to create some tension with that explanation, because if there's one thing that railroad managers knew how to do in the 1970s, it was manage costs. And I've put up a quote here that we pulled from the trade press. We get costs, but we didn't know anything about pricing, and that's why we hired the airline guys. And the control of prices was one of the big effects of staggers. So we've got some data that suggests a cost story with qualitative evidence that says just something more about revenue and pricing power, and we want to square that. All right. Now, understanding the mechanism through which staggers affected economic outcomes in the industry is really important. I mean, think from the standpoint of a policymaker who might be interested in how deregulation in other settings would affect growth in the industry. Or how about this question? What would happen to the rail industry if regulation were reintroduced in some form or strengthened in some form? Or another question, not at all related to regulation, could you take the lessons of the railroad industry and apply them in some form of industrial policy to create or encourage growth in non-regulated markets? Okay? Our ability to answer all those questions is regrettably limited unless we can understand why it is that regulation had this impact in the railroad industry. All right? In other words, if we're going to extrapolate based on our experience, our credibility doing so is a little bit weaker than we might prefer. All right, so if we're going to talk about economic growth, the right starting point is the Solow model. Robert Solow, an economist, Nobel Prize winner. The basic idea from the Solow model is you've got something called output. Okay, that's Y in the equation. It's a beautiful equation I've put up there with arrows so we can all know what's what. Output in the economy depends on capital, It depends on labor, and it depends on something called the Solow residual, which basically means we don't really know what's there. But macroeconomists will say the Solow residual is composed of technology or of knowledge. For a microeconomist, this residual probably would be referred to as something called total factor productivity. All right, so to put a face on the equation, here is Bob Solow. He won his Nobel Prize for this model and other contributions back in 1987. Also well known for his commencement address at Georgetown University 6 years ago, as you're aware of, I'm sure. Okay, so some results from the Solow model. Number one, in the steady state, economic growth is all about knowledge and technology. That it's our ability to understand and to improve on our processes that create growth. So we're thinking about the steam engine, things like this, all right? There's not much of a role for capital, but that's only in the steady state. Capital investments can be an important source of growth as the economy moves towards a steady state. So a classic example would be Western Europe in the 1950s and the 1960s when you had, emerging from World War II, a lot of the capital is destroyed, investments in capital to generate sustained growth. Very important. Eventually, the marginal product of capital diminishes, it reaches the rental rate, and that growth is tapped out. But it's a natural question, could capital investment explain the post-Staggers experience in the railroad industry? And I tee that up as a natural question because we all know that the railroad industry itself is very capital intensive. Okay, so can capital investment explain growth? Well, one thing we can do is we can take a measure of output at a railroad level. So I've got railroad year observations, and we can ask whether various inputs explain how much the railroad produces. So I've got a measure of output, some notion of ton miles, okay? I'm going to regress it on some inputs, including a measure of capital, labor, fuel, and we'll just see if this is associated with more production, and indeed it is, that capital is associated with greater output. If you wanted to interpret the regression, specifically, the coefficient on capital, 0.26, means a 1% increase in capital is going to increase output by about 26%. But capital growth ends up being too small to matter. It's going to account for less than 1% of the total output growth in the market. Here's a figure that illustrates capital in the industry. It turns out capital growth is actually quite small. Okay, and you can measure capital different ways. I'm just using one measure, but this makes the point across. In this particular regression, if you were to use this regression to explain the growth and output in the railroad industry, all the action is in the residual. It's in this total factor productivity term, which basically means it's a black box and we do not know what's going on. All right, but it turns out that if we dig a little bit deeper, Staggers affects the mix of capital investments. In particular, investments in road or in ways and structures increases, and investments in trains, locomotives, cars decreases. And it's really rather striking. Okay, so this is a graph. I've still got capital up. That's the blue line in the middle. But we can see that by 1990, the total capital invested in ways and structure is up maybe 80% relative to pre-Staggers levels, whereas investment in equipment and trains and locomotives is down, I'm going to say 25% relative to pre-Staggers, okay? Now, both types of capital are necessary for production. As one of our earlier speakers said, trains are all about cars running on track, so we need them both, right? From an economic standpoint, the main distinction that I see is that road is largely an intangible asset. Okay, in other words, once you build your road, those expenses are sunk. It's very hard to get off. There's no secondary market. Rolling stock, our locomotives, our cars are very different. There is a secondary market for locomotives, for rolling stock. And so those assets are what we would call tangible assets. Okay, why does that matter? All right, let me introduce a hypothesis. Okay, this is a four-part hypothesis. My colleague John made me break it apart to make it more easy to read for you. So thank you, John. Here's our theory. Number one, debt obligations pre-Staggers induced firms to invest more heavily in tangible assets that could be liquidated in the event of bankruptcy. This introduced a distortion into the mix of capital assets that reduced productivity due to an underinvestment in intangible assets. Staggers granted more control over revenue management and thereby relaxed the financial constraints faced by railroad firms. Firms were able to re-optimize their capital expenditures towards intangible assets, and over time, they're able to obtain more productive mixes of capital assets. So like I said, that's a mouthful. It's a big story. We're going to try to prove it up as best as I can if the data support it, and we're not really there yet. Okay, so I want to give you 4 comments. Number 1, it's possible to formulate the model I just described, and we've done so in a 2-period model, but hopefully the intuition is clear, and so I've spared you the notation of the mathematics. All right. 2, this is consistent with some stylized facts that folks in the room are familiar with. The 1970s were not a period of financial health for railroads. We had 10 bankruptcy, rates of returns were around 2 or 3%. So we think that the model we're telling makes some sense in that, given those facts. Third is that this is appealing as a theory because it connects the pricing power and on the revenue obtained via deregulation, via staggers, to the cost reductions that show up in the data. Okay, in other words, it's the greater revenue that reduces financial risk, and that facilitates a more productive mix of capital. Okay, so now we can square the data that I showed you at the outset of the presentation with the quote that we pulled from the trade press about how the folks in railroads understood costs, but maybe not so much the pricing. And lastly, let me mention that this is interesting from an academic standpoint. So as an economist, I find this explanation interesting just because it's a novel mechanism that links financial markets to the real economy. My field is industrial organization, and we study market power, oligopolies, monopolies, antitrust, things like this. We don't really consider debt frictions for better or for worse. Okay, the finance literature has studied the impact of debt frictions on overall investment in the economy, and I've listed some papers up here for you, but to the best of our ability, we can't find anything about how debt frictions affect the mix of capital. And the figures that I've showed you here on the railroad industry suggest that the mix of capital might be very important into figuring out what's going on. Okay, I want to show you some econometrics, and I'll describe these as 2 early econometrics, okay? But this was easy for me to produce yesterday to support the slide deck. So I'm going to revisit the very simple regression specification that I showed you before. I'm going to replace capital with both road and rolling stock. And we'll ask whether firms that have more road or more rolling stock produce more output. And in fact, they do. And maybe this isn't surprising. The coefficients in the regression take the expected sign. There is a theoretical sense in which this regression is too simple to go where we need to go. I will also say the data are not adjusted for betterment accounting, which maybe a handful of you in the room know about, but it ends up being really important. Okay, and so we need to do 2 things. One is to bolster up our regression specification and very importantly correct the data. So that's, if we're going to think about the path of this research project going forward, we're going to adjust in the capital stock. We will be estimating a production function a la Gandhi, Rivers, and Vong, a very nice methodological piece. And we'll be seeking to answer a couple research questions. Number 1, is it the case that the industry moves towards a more efficient capital mix in the 1980s? I mean, we know that the mix of capital changes, right? But we'll be trying to show that they end up somewhere that's fundamentally more efficient than where they started. And then we'll also be able to answer the question, how much of the pre-staggers productivity boost can be attributed to changes in the capital allocation? And that's our objective. We've got to start. We've done a lot of the modeling already, so it's about implementation at this point. Okay, I want to get back to the motivating slide. We're trying to think big on this question because the economic growth that the railroad industry experienced in the 1980s really is remarkable. We want to improve our ability as a community to explain and extrapolate from the experience. Currently, as I stated, our ability to answer the questions is regrettably limited, but I will add, hopefully, just for now. Okay. Thank you for listening to the talk. I'll be around afterwards, so I think John is going to close with some comments. If you can stick around, talk to me or to John or to Mark. We would love to learn from you and hear your perspective on this. Okay, thank you.